My permanent subcommittee on investigations has spent about the last 10 years learning about tax avoidance schemes, which we estimate, and more importantly, other experts estimate, cause the cost of the U.S. Treasury about $100 billion a year, or about $1 trillion over 10 years. And there's a sheet which we have handed out, which gives you the source of that estimate of $100 billion a year. Tax avoidance schemes involving offshore tax havens, abusive tax shelters, are what we are after. And these schemes do a number of bad things. First, they undermine public confidence in our tax system. They cost the Treasury a fortune. They increase the tax burden on average, honest, working people. It places an unfair disadvantage on businesses that don't use these gimmicks. These schemes give incentives to move jobs offshore. Now, this is about the 5th Congress that I've introduced legislation. A comprehensive bill to combat offshore schemes and tax shelter schemes. Some of the provisions from previous bills have made it into law. Most have not. So this bill provides some very, very powerful tools which we need to clamp down on these offshore tax abuses and these tax schemes to avoid paying taxes. And I'm going to go through some of them with you. We've handed out a sheet which gives you a very quick summary of these provisions. There are 18 provisions, and I'm just going to select a few of the provisions to highlight, and I'll give you the number on the sheet as I go through the ones that I'm doing the highlighting on, and then after I'm done, we will have staff go through, at least B will go through these in more specifics. The first one that I want to highlight is provision 101, which would authorize what we call special measures to stop offshore tax abuse. And to boil this down, it amounts to this. If there's an offshore bank which does not cooperate with our tax people, at that point our banks will be told that they can no longer do business with that offshore bank. And that means, for instance, that if the offshore banks will not have access to American credit cards through that American bank. But we will stop doing business with offshore banks that do not cooperate with our tax authorities and which impede U.S. tax enforcement. Section 102 creates a rebuttable presumption that if somebody forms an offshore entity or sends them assets or receives assets from that entity, that person is in control of that entity. Of course, the control is key. But it's very hard now to prove control. The burden is now on our tax people, even though an American is the one who forms the corporation offshore, sends them assets, receives assets, or benefits from that offshore corporation. Nonetheless, you've got to be able to have evidence of that and then prove control. What we do in Section 102 is create a rebuttable presumption that if you do any of those things, you are in control of that corporation for tax purposes. The next provision that I would highlight would be 103. This has got some similarities to the Section 102, but here what we do is say that if you manage or control an offshore corporation from the United States, that you are going to be treated, the corporation will be treated as a domestic U.S. corporation for tax purposes. So when you create a corporation down in the Caymans, you're creating it, and your business is in New York. You're a hedge fund in New York creating a Cayman corporation, for instance, but you're controlling it from New York, your employees are in New York. That Cayman corporation or that offshore corporation is going to be treated as an American corporation, no matter where it is incorporated. Right now, wherever you're incorporated determines if you're a U.S. corporation or not. So if you are incorporated in the U.S., we treat you as a U.S. corporation, but if you're incorporated in the Caymans, you're treated like a Cayman corporation. That's going to end. If you manage and control a foreign corporation from the United States, you are going to be treated as that will be treated as a U.S. corporation for tax purposes. There's now a loophole in the law which is created as follows. If you have a credit default swap, a bet, and you are making payments on that swap to a foreign corporation, that payment is considered as being sourced where it's received. So if you're sending a payment for your bet that the price of something is going to go up or going to go down, and you send that payment to a British company or to a Cayman company or somewhere else, that payment is considered sourced where it's received. That is because of the loophole created by a Treasury Department regulation some years ago. It's absurd that you source money where it's received instead of where it comes from. That's going to end if our bill is adopted under Section 105. That money will be treated as income where it comes from, where the source is, and will be taxed accordingly. Section 106, we're going to close the foreign subsidiary deposit loophole. If you deposit money, if you, a foreign corporation, deposit money in an account in the United States, including a correspondent account from a bank, say in the Caymans, we are going to tax that money that is in a United States bank as a constructive distribution by that controlled foreign corporation to a U.S. parent. So right now, if you earn money overseas, and you have a controlled foreign corporation overseas, and that controlled corporation puts its money in a foreign bank, but is told that by the owner of the money that it wants that money to be kept in dollars, that foreign bank will open a correspondent account in the United States. And by the way, can invest that money and do whatever else it wants with that money in the United States. So the fiction that a lot of this offshore money is kept offshore would be punctured, because a lot of the money, and we know, and there's now data on this, probably in the trillions, is not kept offshore, but in fact is in correspondent accounts here in the United States, where it has the protection of U.S. banks, it has the security of U.S. banks, and can be invested at the direction of the owner of that money in whatever that owner wants to invest it in and can earn interest on. So we would treat that money that is put in the U.S. bank as a constructive distribution by the controlled foreign corporation. to its parent here in the United States. Finally, we would require, in terms of my commentary, we would require annual country-by-country reporting by SEC-registered corporations on the number of employees that it has in foreign corporations, and the approximate amount of its sales, financing, tax obligations, and tax payments. This is readily available information. It will help a great deal in terms of law enforcement here and in terms of the ability of our tax people to know where and how to treat this income. Now, those are just a few, again, of the 18 provisions in our bill. There's a lot of disagreement about how to reduce the deficit. But I think most people agree that clamping down on offshore tax abusers is one way to surely reduce the deficit. People talk about tax reform, and if people are serious about tax reform, these provisions are a very important part of tax reform. You've got to eliminate incentives for companies to move overseas. Right now there are too many tax incentives for companies to move jobs overseas, and we've got to eliminate those tax incentives. We've got to end the unfair discrimination that exists against companies that don't use these kind of gimmicks. It's very unfair. We're going to hear more about that in a minute. It's very unfair to companies which keep their companies here, don't go through this gimmickry of creating these offshore corporations to avoid paying taxes. It gives an unfair advantage to those who do over those who don't. The patriots who stay here should not be paying a tax price for staying here. That is not a burden which ought to be placed on their shoulders. So deficit reduction and the great impetus that we have now to reduce our deficits, and that's connected, of course, to the question of whether we're going to increase the size of or the national debt limit. But that impetus that exists to reduce our deficit now, I believe, will give enough momentum to our bill to have it see the light of day and to be adopted. That's our great hope. We have the same co-sponsors this year as we did last year. Senator Conrad, by the way, highlighted this offshore tax abuse as in his speech on the floor yesterday, and made a number of references to the work of our subcommittee. The bill is supported by a wide array of small businesses, labor, public interest groups, including the following: the Financial Accountability and Corporate Transparency Coalition, the American Sustainable Business Council, Business for Shared Prosperity, the Main Street Alliance, the AFL-CIO, the SEIU, Citizens for Tax Justice, the Tax Justice Network USA, U.S. Public Interest Research Group, Global Financial Integrity, Global Witness, Jubilee USA, and Public Citizen. Now, one representative who is with us today is the President and CEO of the Small Business Chamber of Commerce in South Carolina. Frank Knapp will tell you why he supports the bill, and then after he is done, there is a man who will talk to you over the phone whose name is Paul Eggerman. He is the founder and CEO of a health information technology company called eScription Boston. He'll be, again, joining us by phone, and he'll tell us why he supports the bill. And then we will come back to me for some questions, and then turn it over to my staff director down at PSI, Elise B. So, Frank Knapp, thanks for being here.